Welcome to EVNTAlpha, where I cover economic news and data, the S&P 500, and stock trading signals with captivating historical performances. With the S&P at a crucial technical spot for its current rally, the next 2 weeks are one of the most pinnacle times in its history. With geopolitical controversy re-escalating in one of the most important weeks for monetary policy, are stocks ready to keep going, or are we in for another grueling pullback? The conflict in Iran is continuing to escalate as it was reported today that the U.S. struck an Iranian naval base using sea drones. In addition, U.S. CENTCOM forces will resume blockading maritime traffic entering and exiting Iranian ports tomorrow at 4 p.m. Oil spiked over 8% today after the news came out, in turn causing the NASDAQ and S&P to sell off, which really highlights how fast conditions can change with the current environment we're in, with geopolitical tensions high, invoking further fear of inflation impact. Take a look at this tweet from Bull Theory, which highlights every development in this conflict and how it shifted crude oil. As you can see, every time we've seen escalations like today, it has resulted in massive swings in oil futures to the upside. Now, this is very bad for innocent lives, the economy, and less importantly, stocks, as oil futures rising again puts pressures on inflation, as well as the Fed's decision on interest rates. The biggest concern for the Fed is inflation risks, much more so than the risk of slowing growth in the economy at the moment. So if oil continues to remain high, we will certainly see hot future CPI prints, and conversely leading to the Fed to lean more towards rate hikes. It was also reported today that Trump plans to make a speech to the nation Thursday night at 9 p.m. Eastern Time regarding an unknown topic. It's up in the air what will be talked about and how it will impact things moving forward. So definitely be careful in the markets this week, as we can already see with Monday. Uncertainty is at an all-time high, and there are a ton of updates this week that are really going to spike up volatility. Coming up tomorrow at 8:30 a.m. is our CPI print, which is arguably the most important update we will have all year regarding how the data coming out will impact the Fed's decisions. With many in the committee already convinced that rate hikes are appropriate, this could be what creates the breaking point between the split opinions of the Fed. We will hear Kevin Warsh's testimony shortly after at 10 a.m., in which we will get a better picture as to how the Fed is interpreting the new inflation data, and if this causes further concern amongst the committee. We also may get a better idea of what level of inflation worries Warsh personally, as if the update is very bad, it may be picked up on in how dovish or hawkish his language is, along with the body language he invokes when answering certain questions. In other news, AI-related debt jumped 99% over the past year, highlighting how out of control AI-related spending has gotten, as AI companies race to develop their models and bring the best product to market. Many investors are still very concerned about this incredibly high spending and question how worth it will be in the long run. While many of these AI companies have had very strong revenue growth, the continued growth required to break even on the spending is exuberant and quite the hill to climb, making many investors question current valuations and future profitability potential with the near-term margin pressures this kind of spending causes. With earnings season firing back up again with big banks reporting this week, followed up later by major tech companies, the focus of investors has slightly shifted from geopolitics to AI earnings. Given the shock of increased AI spending, many are looking towards tech earnings to show strong growth to support the increased spending. Rob Almeida, global investment strategist for MFS Investment Management, said oil and Iran do matter, but they matter in terms of their potential to implement inflationary supply shock. Investors have learned to view such episodes through a single lens, namely which companies can pass higher costs through to customers and which cannot. That's what will drive future earnings. Attention has moved decisively away from headline geopolitics and towards structural forces that are reshaping the market. Those factors are most likely to drive equity returns over the next 12 to 18 months. What Rob is saying really makes sense when taking into consideration how mild of a sell-off we experienced today relative to how severe the news truly was. In other words, what he is saying is the focus is shifting to what will be the areas that benefit the most from the capital-intensive environment due to AI bottleneck, such as hardware, memory, power equipment, utilities, and grid modernization as we move into earnings season over the next couple weeks. Now let's jump into some S&P price action. We have yet to break back below our trend line from the bullish triangle breakout, so the bullish break is still valid. However, notice we rejected our pivot high at 75.78, labeled as B, amidst the news this morning as things began to escalate further. This nullifies our ABCD pattern for now, and until we breach past that pivot high, those upward targets at 76.44 and 77.53 will not be in focus. Remember, we get these targets by measuring a 1.236 and 1.618 retracement of our B to C move. Really, our big focus now that we rejected our B point is how do we react in the yellow zone, now that we have breached back below the 78.6 retracement at 75.39. If we fail to hold this yellow support zone and close below it, we could be in further downturn back to the 7300s, similar to our rejection back on June 15th during our Fed meeting, in which there was a major hawkish shift to a higher chance of rate hikes. If we continue to hold the yellow zone as support, we will be looking to see if we attempt to breach our B point again, and if we do, those upward targets highlighted before will be back in play. Now I want to talk a little bit about SpaceX. SpaceX has continued to tumble down, nearing its IPO price of $135 in the primary market. By the time it opened around 11:30 a.m. to the secondary market, demand had drove it up to $150 a share. However, this was short-lived as the FOMO rally recently ended abruptly. This is generally why I like to stay away from IPOs the first 6 months, as this is generally how they play out, in which retail will drive a FOMO rally and institutions sell it off, leaving most in the end in the red. Generally, with IPOs, a majority of shares are locked up until what's called lockup expiry, in which holders of that restricted stock will be finally able to sell. As you can see in this diagram, a majority of shares are still restricted, and ultimately, as more and more shares are released, this tends to lead to more sell-offs. I measured a retracement from the open to secondary market to the peak of that FOMO rally, and generally speaking, if we do start trading below 135, it's very possible we see some of these lower retracements at 1.236, 1.382, and 1.618. Generally, we should start seeing institutions buying in this region, so paying close attention to how price and volume react to these retracement levels could give a good hint as to when that is. So the first stock I want to talk about is ticker AMP, in which a strategy called Trender signaled off today, 713. Now, Trender uses a measurement of volatility called ATR to create these bands that are offset. And whenever you break outside of these bands, typically it means price will likely go or continue to go in that direction, as it's usually paired with really good or bad news that drives up volatility, and you see jumps in price that you wouldn't typically see in its normal trading environment. Now, over the past roughly 7 years, we've seen 7 triggers, in which the price rose on average about 15% over the next 74 trading days. I also want to note over that 74 trading day period, it also outperformed its sector index just about 8 and 7% on average over that time frame. When looking at those 7 historical triggers, about 86% of the time the price was higher when looking at the 74th day. And so it's performing at a 5.67 profit factor, which means that your wins are about 5.5 times larger than your losses on average. So if it were to continue to perform at that profit factor, even if you were to win only 15% of the time, you would break even. So taking a look at AMP's reactions to those trender buy signals, on the x-axis we have trading days out from the signal, and on the y-axis we have cumulative percent change. So in other words, what you're viewing here is what your returns would be if you had bought AMP on each one of the buy dates and then held for 120 trading days. Now I want to point your attention to the blue line, which is the average return across all the historical triggers, in which we can see it lead up to that roughly 15% on the 74th trading day, right? Notice, generally speaking, there's a lot more upside potential than downside potential in this time frame. And we saw some drawdowns, 12% and roughly about 7% in the first 2 months. So that means we potentially could see cheaper prices than the close of today. However, history shows it's much more likely to go up than down if it performs anywhere close to how the average does over time. So if AMP were to achieve that 15% on average that we saw historically, that would bring it to about $596 a share leading into October 27th of this year. I put a downside risk about 5% to respect a 3-to-1 ratio. However, you can always set your own stop loss that's palatable for your investment style and risk structure. A few things I want to point out here. So I went ahead and applied some major support and resistance zones that AMP is trading within as well. Also notice the major trend line that it's been developing since February of 2025, in which we saw a breakout back in January of this year that failed the retest, right? So when it came to retest the break, it started trading back down through. So this invalidated our trendline break. We had yet another one just on Thursday, July 2nd. And generally speaking, whenever you have these triangle breakouts over these trend lines, it implies you go to test the pivot highs that were created along the way, right? And so we just tested our first pivot high, right? Our next target's going to be around 549-ish, right, on our second pivot high. Also, notice we came up to that pivot high before and faced some severe resistance, right? So if we do start trading up to this level, really be paying attention to see if price rejects and starts trading back down. That could implicate, we may not see further upside in the near future. Now, ultimately, if we do break past this resistance, our next resistance zone is going to be around 571 to 585, 584-ish. Now, if we break that 15% is very likely, as it's already made its way majority of the 15% at that point. So you're really going to want to look out to see if we continue to push up towards this resistance, right? Or if it starts trading back below. Maybe if you want to use like this swing low as a reference, right? And ultimately, if you see it do start trading back below, right? And it also breaks our trend line, this could be an indication that, it's not ready to go higher. So the second stock I want to talk about is DG, in which whenever we saw a bullish cross above its simple moving average, it rose about 17% on average over the next 69 trading days, or just about 3 months and 2 weeks. Now, I optimized the moving average to identify what is the best period to mimic, the swings that the stock will experience. Now, for this optimized period, we saw 7 triggers over the past 7 years, in which about 86% of the time the price was higher when looking at that 69 trading day. Also notice, relative to its sector and index, it actually had some significantly strong outperformance on average, showing that it tends to be an outperformer to the sector and index whenever we get these signals. Last thing I want to note is it's been performing at a profit factor of just about 3, meaning its wins are about 3 times larger than its losses on average. So if it were to continue to perform at that profit factor and you were only right 25% of the time, you would break even. Taking a look at DG's reactions, again, on the x-axis you have trading days out from the signals, and on the y-axis you have your cumulative percent change. So what you're seeing here is what your returns would be if you had bought DG on each one of the trigger dates and held for 120 trading days. Now, if we look at the blue, we can see it leads up to just about that 17% on average on the 69 trading day. And in terms of the first, roughly 2.5 months, we do see some significant drawdowns of upwards of 14 to 15%, signifying, we could see some drawdowns before it gets better relative to our trigger price. Now, again, there's a lot more upside potential than downside potential looking at our historical reactions. 85% of them ended up in the positive when we got to that 69 trading day. And essentially that was just one signal that occurred that was in the red at this point. So if Dollar General were to achieve that 17% on average, that would bring it to about $144 a share leading into October 19th. I put a 5.6% stop loss to respect a 3-to-1 ratio. And some other things to point out here. So Dollar General recently broke a very long-standing trend line that's been developing since January and December of 2022 to January of 2023. We recently had our break on June of about a year ago actually. We had our break on June 25th. We went on to retest this trend line and bounced off, right? So this kind of validated our trend line break and confirmed that it's likely to go on to see higher prices, right? We broke this resistance that was developed, signaling, prices were likely to go higher. We saw that, and we came down to retest this zone that was developed on the trendline retest, right? So now that we've bounced off, we're back above this resistance, right? That's a really good sign that we're maybe going on to retest these higher resistance zones again. Now, should we start trading back below this now support, right? That brings our lower support zone back into picture around $95 to $100 a share, right? And so, these two resistances and support are going to be a good indication as to where the price is likely to go. So the third stock I want to talk about is Netflix, in which an indicator called RSI just signaled off a buy this Monday, 7/13. So with RSI, it's a unit of measurement you use to understand a stock's momentum. And so typically when you go below 30, this is what you call oversold, in which when it crosses back out of 30, this is your buy signals, right? And vice versa, we have what's called overbought if you're over 70. And when you cross below, that's a sell signal. Now, I went ahead and optimized a RSI value for Netflix, in which it's 28.75. In which every time RSI crossed above 28.75 on the weekly frequency, the price rose on average 33% over the next 103 trading days, or just about 5 months. Also notice its performance relative to its sector and index, also fairly strong outperformances on average at 31% and about 25% relative to its sector and index. Now, of the 4 historical triggers, we've recorded the full 120 days out. 75% of the time the price was higher, or 3 out of the 4 times. Now, we've had a 5th, 6th, and 7th trigger recently, just in the past 4 months, 1 being in February and 2 being bunched here on July 2nd and July 13th. Now, these 3 are not being incorporated in these statistics and won't be until each one of them finish out their 120 trading day duration. So taking a look at Netflix reactions to those RSI buy signals, in blue you can see the average lead up to that just about 33% on the 103rd trading day. Again, we aren't incorporating any of the triggers that haven't finished out the full 120 days. So the last 3, which are in orange, 1 being here down 4%, the other being currently down 22%. The third has not populated because we're on day 0, right? Once, more time has passed, a third yellow line will start generating. Now, in terms of the trigger on February 27th, we saw it jump about 12% the first 2 months. And it was very much performing in line with some of the positive reactions we saw from Netflix with these RSI buy signals. However, on the fundamental side, we had some issues, which we'll talk about a bit later, as to why it started to sell off, and we're now down about 22% on that trigger. So if Netflix were to achieve that 33% on average, that would bring it to about $98 a share leading into December 4th of this year. I put 11% stop loss to respect to 3-to-1 ratio. However, that can be set however you'd like. That's not a concrete or strict thing you have to do. I went ahead and also plotted some major support and resistance zones to pay attention to, as whenever it's reached these zones, it generally is a pivotal moment and gives you a good indication of which direction it's going to go from there. Currently, we're retesting the support zone, right? We bounced out of it once, we're retesting it, and so now we'll see if we bounce off the support zone again. If not, that brings our lower target around $58 to $54 a share, which would be our next support zone, next major support zone. Now, Netflix peaked this year in about April, and so, it entered a pretty meaningful pullback, and this is what I was talking about when we're looking at the reactions. It jumped around 11% before it actually went on to be 22% lower than the actual trigger price. And so there was a couple reasons why we saw this pullback. First being valuation became extremely stretched, right? Netflix had become one of the most expensive mega cap stocks, and it had roughly doubled in the previous 12 months. And it was trading at a historically elevated forward earnings multiple. So expectations had become extremely high. Whenever you have very high forward earnings, essentially it's being priced in that this company is nearly perfect. So even good news often isn't enough to push the stock higher. So also, a lot of it had to do with profit taking. Large institutional investors often reduce positions after gains of 80 to 100%. And so ultimately you can see there was a really huge volume spike when we reached up there. A lot of this was profit taking, as hedge funds and want to lock in gains, mutual funds rebalance, etc. In addition, investors were questioning how much subscriber growth remained. Netflix has very much matured, right? And so the question is, how much more streaming subscriptions can they get? How much more can margins expand, as they've already benefited from password sharing crackdown, advertising tiers, and price increases, right? So what is the next big thing they can do to really enhance their margins? And so ultimately, there isn't really bad earnings with Netflix. They still have very strong revenue growth, very strong subscription rates. So all in all, the April decline was driven more by valuation compression and changing market positioning than by a deterioration in Netflix business. And so the main reason I say this is just to kind of emphasize that this is still a very strong company with very strong historical returns. And so it shouldn't be counted out as, a stock that should just continue to drop to zero or just continue to drop as it's worthless. Similar to something like Adobe, where, what was being priced in is essentially unquantifiable, which was the damage that AI was doing to the software industry. And essentially, the cost of web development and software development were essentially useless with AI making it so efficient and easy. So ultimately, given it's taken such a large hit, I'm fairly optimistic about this trigger. Ultimately, we want to see that bounce off that support zone and start trading through this resistance zone now. If we do, we're likely to see that 33% on average and maybe see a retest of this resistance zone around $100 a share to $109 a share. So last stock I want to talk about today is ticker GDDY. And what you're viewing here is the premium or discount percentage to the 200-day moving average. And so this is measuring how far the price will deviate to your 200-day moving average. So if you see it at 30, for example, that means we're 30% higher than our 200-day moving average. And if you see it at negative 40, right, that means we're 40% below our 200-day moving average. Now, the cool thing with this measurement is you can often use it like an oscillator, such as RSI, for example, in which you can identify certain extreme deviations away from the average, in which the price tends to revert back to the mean, right? So generally with mean reversion, your target is to the moving average itself. Anything past the moving average is a cherry on top situation. Now, in particular for GDDY, anytime it's dropped more than 12.5% to its 200-day moving average and then crossed back above that threshold, it rose on average 20% over the next 101 trading days, or just about 5 months. And of those 22 triggers over the past 10 years, 95% of the time the price was higher when looking 101 trading days out. Relative to the sector, it moved about 9% on average, and relative to the index, it outperformed about 14% over that 101-day duration. We had our 23rd trigger just this past Monday, so it'll be interesting to see if we see similar returns to the average this time around. The last thing I want to point out is the profit factor, in which it's performing at a profit factor of 6, which means your wins are about 6 times larger than your losses on average. And so ultimately, if you were to continue to perform at that profit factor and you were only right about 14% of the time, you would break even. So taking a look at GDDY's reactions, in blue we can see the average lead up to that roughly about 20% on the 101st trading day out from the trigger. Now, two things I want to point out as well. We did have some two significant drawdowns in these reactions, and both around 30% lower, right? So again, this is kind of highlighting there is some significant downside risk based off reactions. And so a stop loss is going to be incredibly important. You're going to want to set it to what you're comfortable with losing, or what's, makes sense for your investment style, right? If you're looking for a larger swing, maybe you increase your stop loss a bit more, and vice versa. If you're looking for a smaller, quicker return, you have a stricter and more conservative stop loss, for example. But yeah, ultimately you're seeing a lot more upside than downside in terms of looking at all the reactions, right? A majority of them remained, within 5% of the trigger price, right? With a few stragglers being the ones that actually deviated to the downside very far. So if GoDaddy were to achieve that 20% on average, that would bring it to about $109 a share leading out to December 3rd of this year. Now, to point out a few major things, first, we had a very long-standing trend line that broke on November of 2023 and went nearly a year and a half, or 2.5 years, I should say, without being retested, right? So we broke it and never saw these prices again for almost 2 years. We came back to retest this trend line and noticed these two incredibly extreme bounces off this trend line, right? So this is a very bullish sign that we're going on to shift to bullish, for example. A good zone you can look at to identify if we are in fact going to break out higher is this resistance zone here. Notice we've pivoted off of it to the downside roughly about 5 times now, just in a span of a couple months. So you're really going to want to see it start trading through this resistance zone if you are a bull. And ultimately, if we should see this, generally speaking, there's not much resistance or support that has much structure in between, $122 a share and 90, right? So if we do break through, that's a pretty good indication we are going to go on to retest some of these higher resistance points, especially if we reach our 20% on average that we saw historically. And that's all for today. If you enjoyed the video, please give it a like and subscribe, and I hope to see you in the next one.